We have an analysis report today that makes a really high-energy, bullish case for Western Digital, or WDC.
Yeah, it's positioning the stock as the next big AI trade.
Exactly. The whole thesis is built on WDC's role in data storage, what it calls a valuation gap, PE around 26, and a very recent technical breakout.
And it is captivating. I mean, you read it and you immediately get the point. It's a clear thesis, very concise.
It's designed for action.
Right. But, and this is our first point, that energy, that urgency might be a double-edged sword.
So you're talking about that tension between making an urgent call and maintaining analytical credibility.
Precisely. The highly urgent and hype-driven tone, while it is engaging, it risks diminishing the overall credibility of the underlying financial analysis for, let's say, a more sophisticated readership.
I saw that too. The material uses some really loaded phrases, like the perfect AI trade.
Yes.
And it even says the desired tone is high energy, urgent, professional, but hype-driven. There's also that line that just states, flat out, the breakout is confirmed.
And that's the weakness. That vocabulary is really optimized for driving immediate movement.
Chasing the breakout.
Yeah, chasing the breakout, retail enthusiasm. For an analysis that wants to be seen as serious investment research, that aggressive tone can raise immediate red flags for experienced analysts.
They start to question the objectivity.
Exactly. They might think the focus is more on generating FOMO, fear of missing out, than on a balanced risk assessment.
So what's the suggestion then? If you strip out all that excitement, you risk losing the very audience that could help fuel the trade, right?
That's the challenge. The suggestion isn't to remove the enthusiasm. It's to recalibrate the language. You want to show that your confidence comes from the data, from strategic conviction, not just from a line on a chart.
So it should feel more like a high-conviction investment thesis that just happens to have a really timely entry point.
You've got it. More proof points, less noise.
Okay, so let's get concrete. What kind of language adjustments are we talking about?
Well, instead of saying the stock just woke up in a major way or calling it the perfect AI trade,
You could frame it more professionally.
right, position it as something like a high-conviction AI storage play, or maybe an undervalued AI infrastructure beneficiary. It has the same punch, but it uses institutional language.
And what about that breakout confirmation? How do you handle that part without sounding so absolute?
You move from just declaring it to actually presenting the evidence. So the original says, look at this chart from yesterday. This isn't a fluke. This is institutional buying.
Okay.
We can get that same conviction across, but we do it by quantifying it.
So instead of just saying, look at the chart, you'd say what?
You'd say something like the volume spike on the 52-week breakout day exceeded 3 times the 90-day average.
Ah, okay.
This suggests significant institutional accumulation, differentiating this move from typical noise. See? It's objective, it's quantitative.
It shows how you know it's institutional buying instead of just feeling it.
Exactly. That small change instantly elevates the entire analytical standard of the report.
That makes a lot of sense. Okay, let's pivot to the core of the thesis. This whole idea that WDC is the, quote, backbone of AI storage.
Right. And to really establish WDC as a true backbone that deserves a premium AI multiple, the analysis has to go deeper than just general statements about the data explosion.
I mean, the piece does make a strong case for the overall demand. It highlights WDC supplying these massive 26-terabyte hard drives and enterprise SSDs to the cloud giants, the hyperscalers.
And that's laid out very clearly. But my question is, how does that general demand translate into a unique, defensible, competitive advantage? I mean, hardware is a tough business.
It's cyclical. Margins can get compressed really fast.
And that seems to be the core weakness here. The analysis talks all about the surging demand, but it kind of sidesteps the risks. You know, fierce competition from Seagate, those unpredictable demand cycles.
Yeah, it's not really addressed.
And there's a bigger gap. The connection between general data storage and AI-specific storage isn't fully nailed down.
What do you mean by that?
Well, AI workloads, especially training these huge models, they demand very specific things. Super high IOPS, ultra-low latency, special endurance profiles.
Okay.
So if WDC is the backbone, the analysis has to show its technology is uniquely suited for that premium demand, not just for storing more data in general.
Got it. So the suggestion for improvement is to really bolster that connection, to show WDC's unique product differentiation.
Yes, you have to demonstrate defensibility. Show how their tech beats the competition and justifies that AI backbone valuation, rather than them just being another high-volume supplier.
So how do you do that without getting bogged down in, super technical storage architecture jargon?
You start with a focused comparison against competitors, Seagate on the hard drive side, or whoever on the flash side.
Okay.
Then, and this is key, you have to reference the technology that gives them their edge. The report mentions the 26 terabyte drives. Great. Now tell us how they do that.
You mean getting into the weeds with things like MAMR or OptiNAND?
A little bit, yeah. You don't need a physics lecture, but you need to explain the purpose. Explain that MAMR, microwave-assisted magnetic recording, is what lets them pack more data onto a platter.
And OptiNAND? That's the one that integrates flash into the hard drive, right?
Exactly, which improves endurance and reliability for the kind of write-intensive tasks you see in AI data pipelines.
So you connect the jargon to the actual competitive advantage. For instance, you could explain that these technologies mean lower power consumption per terabyte, which is a huge deal for hyperscalers building out these massive AI clusters.
That's the impact. That's what moves the analysis from a general storage play to AI essential infrastructure. It shows the writer did the real work on the product roadmap, and it makes the entire thesis so much more robust.
That depth really does transform the whole argument. Okay, let's move on to the financials, specifically the price target. The analysis puts a lot of weight on that blue sky breakout and a single, very high Wall Street target of $250.
And this is the third major opportunity here. The analysis relies way too much on that technical signal and that one target, without really justifying the valuation based on fundamentals.
Right. As I read it, the argument is basically that the low PE of 26 combined with that $250 target means there's almost 40% upside? And that alone justifies the trade.
Which is a fine starting point for a quick trade pitch, but it's not enough for a deep analysis report. I mean, couldn't that $250 target just be an outlier? An aspiration?
Is the connection between today's PE of 26 and a future that supports a $250 stock price really established?
No, that's the weakness. The report points out the valuation gap, but it doesn't lay out the growth trajectory or the margin expansion you'd need to see to actually get to $250. It's a destination without a map.
And for a legacy tech company like this, that kind of multiple expansion usually needs a big structural catalyst, doesn't it?
It almost always does. And the report doesn't explicitly mention the biggest one on the table, the potential spinoff of the NAND flash memory business.
That's a huge omission.
It is, without talking about how that strategic move could unlock value. The $250 target just feels arbitrary, like it was just pulled from somewhere else, not justified by the author.
So the suggestion is to introduce some high-level valuation scenario analysis. You have to model what it would take.
Absolutely. Show what future earnings per share, or EPS, or margin expansion would be required to hit that target. That makes the thesis fundamentally robust, not just technically supported.
So the breakout gets you interested.
But the fundamentals have to be what keeps you in the trade and justifies the target.
This means the author has to actually own the forecast. How detailed does that modeling need to be?
It just needs to be clear and directional. You could present a simple scenario like, the $250 target implies a forward PE of 40x on, say, FY 2026 consensus earnings.
Okay.
This would require a 15% compound annual growth rate in enterprise revenue. Something concrete. Then you tie that growth to a specific catalyst.
And we have to integrate that strategic element you mentioned, the spin-off.
You have to. Given all the talk around separating the HDD and flash businesses, you need a brief analysis of how that separation could generate that value.
You're talking about a sum of the parts analysis.
Exactly. Or at least the concept of it. You just need to explain how the flash business could trade at a much higher multiple on its own, which then unlocks value for the remaining HDD business.
Right.
Without addressing that strategic unlock, the bullish argument is missing its single most important component for long-term appreciation. It's the key to justifying that $250 number.
That's how you take an analysis from a simple trade idea to a sophisticated investment thesis. It makes sure that even a reader who's drawn in by the hype still finds deep, justifiable analysis underneath.
You maintain the excitement of the trade, but you back it up with the durability of an investment.
Okay,